A lot of investors had a rough day yesterday, but what, if anything, have market participants learned this week? Jan Randolph joins us now to discuss. Jan, the final US jobs data of 2015 is just out. 211,000 jobs added. The Fed now has what it needs for a rate liftoff, or does it?
Yeah, I think so. The IHS forecast is for the rate rise hike to start in December. It'll be very small, gradual and gentle. I think the emphasis has to be there. I think the concern earlier about global risks have faded, particularly the China stock market crash and emerging market growth slowdowns everywhere. I think the US economy, though, is where it's still central, and so is the labour market there, and everything there, the signals are everything is firming up and returning to normal. And I think with the jobs report today, still showing good expansion after a blistering good October, I think they're ready to raise.
If we rewind a little, Draghi took flak yesterday for disappointing the markets, but the other argument is central banks do talk to each other and it wasn't a mistake. What do you think? Did Draghi drop the ball?
Yeah, I think the build-up of expectations got too high, and so there was a letdown. But having said that, Draghi still continued an expansionary policy, cut deposit rates. He didn't lift the a monthly amount of bond purchases, but he extended it to regions and municipalities. I think the inflation in Europe is still stuck at 1.1%. I think the forecast, though, the ECB they actually raised their forecast over the medium term. That's what's important to them. So they believe that the pass-through effects of lower oil, lower commodity prices will eventually taper out, and that would help lift headline inflation at least. But the euro recovery, okay, it slowed a little. It was 0.5 in the first quarter, 0.4 in the second, and 0.3 in the third. But the PMIs are quite good for last month. So the indications are there might be a gradual acceleration in growth.
The time for euro as a funding currency of choice may be over, which is why euro-funded EM carry trades won't function well. Analysts are saying sterling is a currency to keep an eye out for moving forward. But what are your thoughts?
Eurozone monetary policy is still highly accommodative, and undertaking QE now promised till 2017. So we can't see an interest rate rise at all, whereas we are seeing interest rates starting to gradually rise in the US. I think that still advantages the Eurozone as a funding currency, and with interest rates still rock bottom, I think the opportunities for funding will still remain for the euro.
Now, looking ahead, we'll have the OPEC meeting, French elections, for example, and the conclusion of COP21. But what upcoming events or data releases could provide food for thought for investors as they bide time until the Fed's meeting?
Well, I think Eurozone economic data is still vitally important. Inflation and also what's happening to commodity prices. All those are linked also to the Chinese economy, which has an increasing influence on global markets. I think they are, for Europeans anyway, still of great concern, because we've seen a slowdown in emerging market growth, and there will be a drag on European growth because of that. Also true for the US, a stronger dollar will mean there'll be an external net export drag on US growth. So there's still concerns out there in terms of the global trends. But going to the Fed hike, again, it's the U.S. economy that sits central to what the U.S. Fed actually does, and the indications there are that they will likely pursue the hike in December.
Jan, great catching up with you as always. Thank you. Well, that's all from me for this week. Thanks for watching, and join us again on Monday when our coverage of the FX markets will continue. Bye for now.